Hello and welcome once again to SB Talks. Today is Friday, March 10th, and I am joined one more time by our Chief Investment Officer, Ashley Owen. Welcome, Ashley.
Welcome and hello in the world, wherever you are.
Now, Ashley, this week we had the latest rate decision from the Reserve Bank of Australia. Not a surprise, another 25 basis point lift. And as the minutes came out, we saw they didn't contemplate pausing. They did debate 25 bips or 50 bips, but went with what was the expected outcome.
Yes, 10 rate hikes in a row, which is expected. The question now, and rates are now 3.6-ish% cash rate, which is still historically very low. Relative to normal inflation. It's very extremely low relative to what inflation is running at, which in Australia is still 5, 6, 7, 8% in a lot of cases. So the question, of course, is then how many more? The RBA did make a comment, a few words they added to the extent that this might be the last one before a pause or wait and see.
There was a little bit of conjecture that there's some softness in the data, but not enough to pause in March, but maybe enough to let them take the foot off for a month or two.
Yes, the feeling. Well, my feeling is that the RBA will probably, Philip Lowe will probably blink at the first sign of jobs weakness. And he will then leave it to inflation will then run higher for years, and then he'll leave it to the next RBA governor to try and solve it. Very different to the Fed. This week was a week really of the RBA starting to go soft, and you saw the dollar drop a couple of percent because the dollar's basically people borrowing money in one country and sending it to another country for interest. So you can borrow money in Australia and send it to the US and get another percent and a half on the cash. So the dollar fell on that news.
So that it's worth just stepping that out. That's the market pricing in to say, okay, we did have this rise, but maybe there's not as many further rises to come as we previously anticipated. Yeah.
That's right. So a lot of things drive the dollar, which we've covered in great length in many monthly podcasts and monthly reports. So we don't try and cover it here. But essentially, it's a global market. Money moves in microseconds around the world. Billions of dollars move every second around the world looking for the best return. With the cash rates 1.5% higher in the US and looking like the next 3 months, that band will increase because the RBA will go harder for longer, and the Fed will go harder and longer. So in say 6 months' time, most likely the Fed rate will be 5.5-ish%, and the RBA rate will be maybe 4, maybe less than 4. So investors are saying, well, I can get an extra 2% on my money in the US, so they can borrow money here or just send money here in cash, sell Aussie dollars, buy US dollars to invest in the cash.
Pick up the arbitrage, the gap between.
And that happens literally every second around the world and every day. So that's the very short-term driver of the dollar. So the dollar's weaker.
Well, can we actually step across to that then? Because there has been significant sort of further information or analysis this week in terms of what the US's outlook was. We have Fed Chair Jay Powell in front of a Senate committee getting grilled by Elizabeth Warren on the impact of his potential rate increases and what it will do in terms of job losses. But he held a pretty strong line and has maintained his fairly firm, let's call it hawkish position around what they're going to need to do to really crush inflation.
Yeah, that's right. This is funny coming from a Democrat Senate which just approved trillions of dollars of free giveaways, which creates inflation in the first place.
Don't seek logic in politics.
That's another thing. Yes, that's right. So everyone started off with zero rates 3 years ago. Fed was early-ish, New Zealand, UK, and the Fed was early-ish and have gone harder with rate hikes in the last 18 months. The RBA was slower out of the blocks, later to start, slower in rate hikes, and the cash rates are lower. And inflation in Australia is a lot higher than the US. Running rate inflation in the US is down to 4 or 5-ish% because oil prices have come down, food prices have come down, a lot of the supply constraints have come down. So worth explaining that
when people see the headline figure, which is always the 12-month backward looking, what you're talking about is actually, when we look at the current quarter and extrapolate that out, that's what we're doing.
So the annual inflation rate in Australia, the CPI basket rate in Australia, which we break down in horrible detail in the report if you'd like to see that, is 7.8%, which means the basket of prices today, or end of December versus the end of December the previous year, that's risen. Now, of course, that rise was created by a lot of the things early in the year with oil prices going up, fuel, food constrictions on supply constraints, etc., borders closed. So the lump of that inflation was mostly early last year. So as oil prices have come down over the last 6 months, that's pulled down the inflation in the US. It's still running at 6.5% in the US, but the running rate, i.e. the last couple of quarters, is much lower.
So some of the shock factors that were in there are starting to dissipate.
That's right. So the aggressive rate hikes in the US have certainly taken about 2/3 of the headline inflation out of inflation. So if you look at the next 2 or 3 more 4 months, because they have inflation numbers monthly, we have them only quarterly, and we get them a lot later, so it's harder to gauge. The inflation number in the US has been solved a lot more than it's been solved in Australia. And yet the Fed this week went to the Senate and said, we've got to go hard. He remembers the Volcker mistake in 80-81 where he paused halfway through. They had this massive double-dip recession in 80 to 82 in the US. He knows that, and so he's keen, even though he wasn't the total cause of the problem of inflation, he knows he's not allowed to pause and risk a double dip, i.e. 2 or 3, 4 more years of pain. So he's spelled out quite clearly, he's prepared, and he says most likely that will cause a deep jobs recession.
You talked about 2 million people losing their jobs, or that was the key debate?
Yeah, so the word recession is bandied around by a lot of people who, and there's no actual real definition. The US GDP, i.e. the economic pie in the US, fell 2 quarters in a row this time last year, which is a normal, what most people regard as a recession, 2 quarters of negative growth. That was a recession on that definition, but the Fed said, or the NBER, which is the National Bureau of Economic Research in the US, which is the thing that calls recession, said that ain't a recession. We want to see massive job losses and pain in the streets. So whether the US or Australia or any country experiences recession next year or this year, on any definition, the answer is most likely, given the rate hikes and the slowing demand out of China and the continued problems in Europe, etc., and the onshoring of jobs into the US and the trade wars, most likely we have a recession, i.e. a rise in unemployment and bankruptcies and foreclosures in Australia and in the US. So the Fed, this week's news is the Fed says, we know that, it's more than likely to occur, but we'll press on regardless to kill inflation, a la Volcker 1981. The RBA did the opposite. The RBA is looking like it's slower, later, cash rates are a lot lower here, inflation, the underlying inflation, the core inflation, the headline inflation, the running rate inflation, they're all higher here by 2 or 3% than they are in the US.
Jobs market also remains still very
strong.
Jobs
market's here. Very, very strong. Unemployment's 3.5%, 3.3%, 3.4%, which is like multi-decade lows. Australians have still got $1 trillion in the bank, sitting in the bank from all the stimulus payments ready to spend.
Do you think
spending is still
strong? Do you think it's a nervousness about this mortgage cliff that we've talked about and heard about so many times that's coming this year with the fixed rate loans rolling off and people going from 2 to 6 something?
Yeah, that's working. I was going to say in Australia's favour. I didn't mean that. What I meant was that is working toward making Australia a far more effective cash rate hike than in the US.
As in having much more impact on the real economy.
That's right. So Australia is, first of all, it's one of the highest household debt ratio countries in the world on any measure. I think Norway, Denmark, a couple of countries are higher. But for most of the world, Australia has the highest household debt to GDP, to household incomes, to wealth, whatever measure you like. It's a very high indebted country. Second element is that Australia is unique in the world in most of our mortgages, home mortgages in Australia, are floating rate, they're variable rate loans, which is never seen anywhere in the world. Even New Zealand, Canada, UK, US, all of those countries are fixed rate countries. So when in the fixed rates in the US, for example, they're all pegged to the 30-year fixed rate loan, treasury bond, which has been rising steadily since the middle of 2020. So they don't have this massive shock. When the Fed gets down, it's largely academic. When the Fed raises rates, people say, oh, that's interesting, maybe business will stop investing and stop hiring. In Australia, we say, my mortgage rate's going to go up next month. No other country has that. So Australia has a very
there's the obsession.
powerful...
RBA rate increase. Do the banks pass it on? It's sort of
Banks they look at their watch and say, well, it's 3.5 seconds. Will I pass it on? Hell yes.
Well, no, I'm going to say it's Friday today, so it's usually about 4:49 on a Friday afternoon they announce that they're passing it through to their mortgage holders, but maybe not quite so much to their term deposit holders.
I'm very old. I'm as old as your parents and most listeners' parents.
A fine wine, Ashley.
For my sins, I was once chief financial officer for ANZ Retail Bank in the 90s, and I chaired ANZ's retail pricing committee,
right,
which sat down every Wednesday and priced every retail product, loans, mortgages, everything, TDs. We had a counterpart in the other big banks, and we would almost compete, half knowingly. The word collusion is easy to attach to that. But it's a long time ago, and the statute of
limitations as well.
But anyway, I was pricing committee chairman for the ANZ Retail Bank. We priced every product, and it was a very fine line as to who would go first. Is it going to be 10 past 1 p.m. or 12? We'll go at 12 past 1, and the Westpac will go at 10 past 1. Now, that's passing on mortgage rates, which are instant hit to the bottom line for a bank, which is good.
And back then, the rates were pretty scary.
We were then, if the cash rate goes up by 25 basis points, 0.25%, the mortgage rate, which affects a couple of $1 trillion worth of loans in Australia, that would go up within the next day. So people would get their notices and their monthly payment would go up next month. In how that funded is, that comes from bank deposits and term deposits. Now, the term deposit is locked in. A 3-year term deposit is locked in for 3 years. So we get the benefit of that. So that's why banks do well with rising rates, because their term deposit base, which is probably half of their entire deposit, is locked into the lower rate. So the bank's funding cost is much slower to rise, and they pass on their rate rises to new TDs, which is only part of the book, much later, a month or two later. So the banks cream it when rates rise.
There's an natural arbitrage in it.
Anyway, that's just a bit of a historical note. But the point is that when the RBA raises rates, that has a dramatic effect on hundreds of thousands or millions of people next month whose payments rise. Now, we've had 10 rate hikes in Australia. Probably, given the lags of letters going out and payments going up, most of those have not yet been priced into people paying more and therefore having less to spend on stuff. So this is one reason.
I would say from probably late last year it's starting to hit, and now reality is well and truly biting, unfortunately.
The second thing is the pot of money, the $1 trillion sitting there from stimulus payouts, is being run down. You look at the profit results from Coles, Woolies and the retailers, JB Hi-Fi, all the retailers just in February the last month gone, they were remarkably strong, and they were saying, look, spending's okay here. We can't talk about the next year, but certainly what they're seeing in the Christmas sales was very strong in Australia. In the US, they had quite a slow retail December, but they had a very strong retail in January. So spending is still strong everywhere, including Australia. So the RBA is saying, to its credit, they're saying, look, it might be worth pausing for a while to see the impact of those lag rate hikes come through to mortgage payments. So that's half an argument for pausing. I suspect that any sign of job losses we've seen a couple of builders go bankrupt in the last couple of weeks. We've had 30 builders around Australia go bankrupt in the last year. Construction and building construction is a large sector in Australia, so that will have a big impact on the RBA's decision to pause rates. So most likely in Australia, it's got higher inflation than the rest of the world in the US, underlying core problematic inflation. Wages are starting to rise. We've now seen wages, albeit it's less than inflation, wages are now rising the strongest.
I think it's 3.6% annualised rate announced.
Doesn't sound like much, but that's the highest rate in 10 years.
Since 2012.
Exactly 10 years. So wages are rising in the US for a whole lot of different reasons. Jobs market's very strong. You can't find people to hire. Unemployment's sub 4%, which we haven't seen in my lifetime, or when I first got a job in the 80s it was higher than that. It's been lower ever since. The RBA was likely to pause and therefore let inflation run for a while, which means the next boss is going to come in and try and solve it.
Do you feel that they're pausing too early?
Yes, got to go hard, got to solve it.
The Fed's clearly going hard. You sort of described the Fed's already about 1% more. That's going to become 1.5%, 2% more than Australia. Australia's possibly creating problems by taking the foot off too early.
That's right. Now, the Australian, all of it is interesting. It gets headlines, but you've got to come back and say, well, so what for investors?
Yeah, and I guess I'll put my financial advisor hat on for a second and say there's lots of positives in terms of where we're at right now as advisors and investors. Is that, we had Tina. There is no other alternative. There is no alternative, in terms of you got to take risk because there's no return in cash and bonds. Well, now you actually are getting a reasonable return, and money has a value, risk has a price, and extreme speculation, when everything's capital is free, is really out the window. It's actually back to a sensible world. Even European bonds potentially giving you positive yields again.
Yeah, even Japan, which is the last bank, central bank still manipulating bond yields and interest rates. Japan is preparing. They've got inflation running at 3%, which is the highest it's been since the 80s. So they are. Even Japan is still lifting rates or getting ready to lift rates. So the so what is, and it's got a few implications. The one which you mentioned is that when cash is free, you can basically, and literally free coming from the government, you can just spend it on stuff, NFTs, Bitcoin, all sorts of funny things they did. All the tech stocks were horribly overpriced. Teslas and the Amazons and the Googles and the Facebooks and Apples and Netflix and the Adobes, all of those stocks were vastly overpriced this time last year, before the sort of rate hikes sort of cut in February, March last year. So the question is, for share markets, and our market, we'll get to in a second, but our market basically follows the US market. If the US market's up for a month or a year or a day, Australia follows 80% of the time. So it's interesting to talk about our local market, but it's dominated by what happens in the US. Can't get away from that. The US market is still 60% of the globe in terms of share markets. So it still dictates the entire market number. So when you've got a share portfolio which has got a bunch of funds or a bunch of index funds or passive funds or active funds, you're going to get basically the share market-ish return, Australia, US, etc., global. The US market has come down 25-odd% and the global market's come down 25-odd% at one point last year. It's down about 15% from this time last year. Come back a bit. Most measures tell us that the US market and therefore the global market as a whole is still overpriced. It's still priced on the basis of 30% growth in revenues and earnings and profits, and in some cases dividends, because most of them don't pay dividends. And that world is gone. So
you unpack that a bit further in your monthly report, looking at
if you go through
technology.
We look at
part of that.
The 10 biggest tech stocks in the world, tech and online, and they cover three sectors: consumer discretionary, which is your Teslas and your Googles. They come in comms or the old telco sector, which is where Facebook and Alphabet, Google sit, and they come in tech, which is Microsoft and Apple and Adobe and those sort of things, Cisco Systems and those. So that complex as a whole is about 40% of the US market, and that's a big chunk of the market to be overpriced. That's why the US market fell most last year, and it's still most overpriced. So anybody with global shares in their portfolio, which is all of us, a good chunk of those portfolios, is subject to this overpricing in the US. If the Fed stops here, even if the Fed doesn't go mad and raise rates to 6, 7, 8%, which it won't, if the Fed sort of stops here and inflation comes back to normal and cash rates sit at normal at around about 5-ish%, which is what you expect normally, the US market will still have to come down to be fairly priced. So that's why when the Fed says things like, well, we're going to go a bit harder, even at the cost of jobs, which means spending will slow and therefore the profit of these companies will slow, that's what's causing the market to go. It spent the last 6 months, it went straight down for about 3 or 4 months last year, then it spent the last 6 months on this sideways seesaw.
Mini rallies and then giving it back
and
again.
It's literally a sawtooth seesaw back and forth. This last month, January was up, everything was up 6%, based on the soft landing scenario. February was down 3% around the world, including Australia, because it turned into a hard landing scenario. We're still in the more likely hard landing scenario, so there's still a bit of downside left. And the US market, and therefore the global market, and therefore everyone's portfolios to varying extents, is still overpriced on this new world of normal rates. The Australian market fell less last year because we didn't have this big tech. All our tech stocks fell heavily. The Afterpays and Apple and all those sort of things fell heavily, and WiseTech and Appen and all those things fell very heavily, down 50, 60, 70, 80%. But they're only tiny. They're not the Microsofts and Apples of the world. So our market's basically two sectors and some shrapnel. One sector is banks, and we know what they're like.
Yep.
They're very highly capitalised. They've got low bad debts. They're well placed for a moderate recession in Australia. And the other big sector is mining.
Which it's had a year of boom time profits and dividends last year, but the market's not expecting that to continue.
That's right. So the risk factors for the Australian market, despite all the talk about interest rates and inflation and recessions, there are two. Every Australian investor in Australian shares faces two monumental risk factors. They are the iron ore price. Now, it sounds funny, but 15% of the entire... There's 2,400 companies listed on the ASX. 3 of those make up 15% of the entire wealth of the stock market. And those 3 are iron ore, BHP, Rio and Fortescue. So 15% of the entire stock market of 2,500 companies listed is exposed to the iron ore price totally, which is those 3 companies. So because Rio and BHP only have half their revenues and profits from iron ore, the actual exposure of the entire share market in Australia is 9% to the iron ore price.
Right.
Massively overskewed to one single commodity, which is completely controlled by other people, China.
By offshore demand.
So that's a very high risk factor for one little tiny element, the iron ore price of Australia. The second single most important risk factor for the Australian share market of 2,500 companies is the 4 big banks who are highly exposed to housing cycle. And so when we talk about Australian share market, despite the domination from what happens in the US last night, the Australian share market is exposed, which means all of us are exposed to 2 factors which are completely outside our control. One is the iron ore price, and secondly is the housing cycle. So that those 2 elements above everything else dominate what happens to Australian share portfolios. So it's quite a skewed, highly concentrated market for that sort of thing, even though we've got
But its valuations didn't become nearly as stretched as offshore and certainly technology over the last couple of years. So it's almost a bit of a reversion to the mean.
So our share market, not like US market, which is still overpriced largely by those handful of tech stocks, the Australian share market is more or less fair pricing. Price earnings ratios, forward ratios, dividend yields, price to book ratios, all those sort of ratios tell us that the Australian share market is more or less fair priced. Now, all of that is interesting but irrelevant, because if the US market tanks 30% like it did last year, and it may well this year,
we will follow
with it. Less so, and we'll recover better because our shape of our market's different, but we will always follow the US on the knee-jerk reaction next morning. Unfortunately, but that's just the way the world we live in.
So as an investor, we have choices, but we've got to be conscious of overvaluations, but we've got other places we could go in terms of fixed income, and the yields in that part of the portfolio with each of these rate rises continue to look more attractive.
Correct. So we have not liked fixed rate bonds for about 3 years now, 2.5 years, 3 years now, and it's worked well because that was clobbered last year. Bond markets had their worst calendar year last year in a century, down 10, 12%, which is unheard of in all of our lifetimes. Even mine. You can now get running yields of 2.5%, 3%, 4% on corporate bonds, which is not bad. You've still got the problem with bonds in that the long or the medium term inflation and interest rate picture for Australia is still for rate rises. So if you hold a fixed rate bond now, 3, 4, 5 year corporate bond that's paying 4% yield, that the capital value, even though the cash flow is good, the capital value of that will fall in the medium term as inflation and rates stay high. So even though the running yield is quite good, the capital losses you'll suffer over the next 2 or 3 years are probably going to outweigh the benefits of the running yield. I'd still rather have
having the longer duration bonds. So rather, still a preference, floating rate debt, and the yields we're getting in that space right now, pushing through the sort of
3, 4, 5%,
up to the 5% sort of territory. Excellent. Any other key risks as you look at from here?
Not really.
We'll always have the geopolitical and other things
lingering
in the background.
China. You've always got people, war build-ups and strategic standoffs. the Ukraine-Russia situation, you can't predict that. It's been running along far longer than Putin or anybody thought. The resistance to the Ukraine is far stronger than anyone thought, certainly Putin thought. On a medium-term strategic level, it is looking like the West is more openly backing Ukraine, West/NATO, and that's worrying for China. At the same time, it is looking also, there's a lot of evidence to say that China is now backing Putin more openly with arms. It's been buying Russia's export. The Russian economy and ruble and revenues of the oil and gas companies, which is the stock market in Russia, has been remarkably resistant, mainly because of the support of China and India. India is, apart from China, India is the second biggest buyer of Russian stuff, particularly military stuff. So India this week is going through, and you saw them in the G20 this week. India hosted it this week, and you saw the Indian delegation being terrified of saying anything negative towards China because they both heavily rely on Russia and vice versa, versus India, who's a democracy, who's an enemy of China, has been to war with a nuclear war with China in the 60s. So they've still got this. I can see a standoff, a three-way standoff between Russia, China, very much together, and India in the West, and India, which is now going to be our next China.
It's the next driver of growth.
India was 20 or 30 years later than China getting out of the blocks for a whole lot of reasons, part of which is because it's a democracy, and therefore it takes 1,000 years to do anything in India. And they get brownouts every second day. You can't turn a factory on, can't turn a light off. So a lot of the problems in India has slowed it down into the development stage, but India is our new China. So strategically watching India, which is very important to us as a country, jostle between its allegiance to democracies and its allegiance to Russia and its enemy state in China. That's fascinating to watch from a distance. How it plays out for investors is more likely going to be things like trade wars and restrictions based on are you a friend or foe. We've managed that quite well with China. We're the biggest export customer, and we are their biggest supplier of a whole lot of stuff.
Despite years and years of tensions and random tariffs.
As it turns out, Australian exporters have been very good post trade war in 2018. Very good at actually diversifying their exposure away from China. China needs Australia more than Australia needs China in terms of exports, and therefore we still sell a bucket load of iron ore, coal, even thermal coal, even LNG now to China, because they need us more than we need them, as it turns out. India is our new China. So watching us jostle strategically between those three players is just something at the back of our mind.
Will be something that will play out over the years and decades ahead, likely. Yep. Ashley, as this is the last of our formal monthly podcast together, I want to say thank you very much for all your hard work and also all your entertainment on these podcasts. I know we get lots of comments and lots of feedback, so I know everyone's very much enjoyed some of it a bit close to the wind and lots of many great insights and other things. So thank you very much.
Well done.
We greatly appreciate it.
It's been a pleasure.
Thank you, Ashley.
And thank you all.
Thank you all. Take care. Have a great weekend.